Now, some of these companies, when you look at Broadcom, trading at a 15 forward PE, great balance sheet, which you can use to buy back their stock. Also, look at the yield at 3%. And I say, okay, this is a stock. It's gotten hit not as much as Skyworks has gotten hit. NVIDIA has gotten hit. But it should place a floor, a little bit of a floor there. Well, maybe we see a little bit of a downturn. Maybe they warn. But that's a nice yield, 3%. Buy back their stock, 15 PE. I mean, Skyworks is a 12 PE. Great balance sheet. 2.1% yield. Target at a 2.5% yield now. 13 times forward earnings. You can see why it's coming back. Do you see Target falling another 20% from here? Do you think it's going to go under 11 times forward earnings and pay a 3% yield? These guys are going to get it right. They got it right during COVID. They got it right the whole entire time, except for this quarter. I hear Kramer on TV and a couple other people, Target's only down 1% now, but they're ripping like the Target. See, it's not limited to Target, just like it wasn't limited to Walmart. And you want to beat these guys up? Wait, you're going to see it everywhere. So at Gap as well, you're going to see so many of these companies warn. It just makes sense, right? You have all this demand and you can't sell anything, which is insane because supply chain issues. So you're loading up and saying, okay, we got to figure this out no matter what the cost is. You spend a fortune to direct it in a certain area where, hey, okay, maybe we're not getting out of China, we're getting out of another area. And now you're getting flooded with this inventory and demand's crashing out of nowhere. And look how fast it happened. I mean, it makes sense, right? That's what we're seeing. But those stocks with high yields that have already gotten hit, that are cheap, strong balance sheets, have much less downside. These are the names you should start picking away at. Then these companies trading expensive valuations and don't pay dividends. Chipotle's 40 times forward earnings, no dividend. NVIDIA, 35 times forward earnings, no dividend. Do you want to own these? I know NVIDIA, I know it very, very well. And I can tell you, one of the biggest things, one of the biggest selling points was when they didn't get the deal done with ARM Holdings. And that was huge for them. That would have created the ultimate monopoly. It was just no way I saw that deal going through. If you really look at the details, it was very difficult seeing that deal going through. The amount of lobbying from their competitors going to the politicians, it was almost impossible for that deal to get through. And the stock ramped up still, went higher, because after that deal, it increased, 40, 50%. It took a while, and then, once that deal fell through, stock still started going higher, but now you've seen it get nailed. And it got nailed a lot more than some of the other semis, but still, when you don't have that dividend, and if it does have a good balance sheet, so does Chipotle, but, 40 times forward earnings in this market? Pretty crazy. So be careful of those names, even though they're down 25% plus from their highs. It's a different market. When it comes to strong balance sheets, but have dividends that have gotten nailed, but are trading at cheap valuations. Not Chipotle, is not NVIDIA. Those are dangerous. So if you pick it away, again, buying those names have gotten nailed already, but have strong balance sheets, pay dividends, along with being cheap. That's a good formula right now. But the good news, this is the bad news, but the good news, the silver lining here, which is very, very big. Okay, we see stocks lowering, margins coming down. We're going to see more companies warning. I get it. Your stock's going to get hit a little bit. But the silver lining here, Target, Walmart lowering prices. Think about that for a minute. That may be the first deflationary event I've seen in 24 months. It's happening not just these small, tiny companies. These are two of the largest retailers in America and in the world. Access to how many consumers are being forced to lower prices. Because they're seeing changes in the consumer. That's good news. It tells us that inflation is definitely moderating. Doesn't mean it's going to come down significantly. Moderating, we need to see moderation. We still haven't seen moderation. We haven't seen the top of inflation and slowly coming down. We need to see that. We need to see it come down a lot more from here. But first, let's see it top out. But in order for inflation to moderate, we must see margins for many companies get hit. That means that they're losing pricing power, they're lowering prices. That's good. And if that's the case, what does it mean for the Fed? Doesn't have to be as aggressive when raising rates. Maybe they get away with raising the Fed funds rate to 2%, 2.25% from, 1% now? Instead of going 2.75, 3%. That's significant. It means just 2 more rate hikes of 50 basis points compared to 4, 5, 6 of what we're seeing from so many firms. Again, hopefully I'm not losing you here with this is what's going on with the market. You want the Fed to slow, and they can't slow unless inflation moderates. And we're finally seeing that. It's not going to happen right away, but over the next few months, yes, it could happen. Because the biggest risk to equities, to markets, to your portfolio is inflation. The one thing the Fed can't throw money at to control. I'm not worried about oil. It's cyclical. Yes, it's going higher and higher, and you see it in record prices. Again, they go higher and higher, and they go low and low, and they overshoot. Okay, it's eventually going to come down as demand wanes, which it will. People are going to drive less with gasoline prices surging over $5 in most areas. Holy shit, $5 for a gallon of gas. That's insane. Business demand is going to slow, meaning less energy usage of factories and plants. You'll see it happen, not right away. But inflation data, which is what the Fed is looking at, and they look at the core, which excludes food and energy, in the months ahead is likely going to show moderation. And food and energy is going to take a little longer. But that's important as we see the light at the end of the tunnel, which we haven't seen. And that's the uncertainty it creates. We're talking 3-4 months now that, hey, we're going to see it moderate. We're going to see it moderate. We're going to see it moderate. And higher and higher and higher and higher for the last 4 months. So we're seeing this massive moves in stocks. The volatility is insane. Nothing makes sense. The leveraging, funds getting crushed. It's very hard to put your money to work if you really don't know what's going on or have any clarity on anything. But we see inflation moderate. That's clarity. That provides certainty. That says, okay, we're close here. Now I could really start putting money to work. I don't have to wait about the stocks really, really falling a lot further from here. After a 30-35% moves, if you own SPACs and recent IPOs that came out past 18 months, you're down 70%, 80%, 90% in some of these names. But in order to see the bottom, that's what you need, inflation to moderate. Everything else, temporary. The war, temporary. They'll figure it out. Yes, it'll take longer. Energy prices, cyclical. Food prices, yes. Again, they're going to remain higher for longer. But the inflation picture, that is the biggest thing. It's the risk we've been talking about for a year and a half. When Fred started putting in that language of transitory, said they're full of shit, it's not transitory. Now we're seeing why that is so important, because the Fed can't do anything to help stimulate the economy like it did for the past 12 years, which is catching everyone off guard. But lower inflation, definitely a good sign. Again, indicate we're close to a bottom. And when we do see that, we're going to see trillions in cash on the sidelines. Balance sheets are flush with cash. It's going to start flowing into areas I mentioned earlier. Stocks with low PEs that got nailed already, which have strong balance sheets and pay dividends. May throw in insider buying there, which you're seeing record insider buying right now. Record insider buying. Something you want to see, which we haven't seen up to 2 months ago, 2.5 months ago. But before that, massive selling over the past few years. Finally, we're seeing insiders go, whoa, and buybacks. Big buybacks and insider buying. So we want to see when your stock's getting nailed. It gives you confidence. These guys know their companies better than anyone. So we bring this all together. We're going to be in for some more pain at least over the next 3 to 6 months. Doesn't mean you can't invest in stocks. We've been picking away. You see some companies start to lower earnings. It may be factored in like you're seeing with Target, down just 1%. It was down 8% really quick. Again, algorithms kick in. Companies are able to trade the markets before they even open, but it's only down 1%, meaning that a lot of this is being factored in with stocks getting crushed already. Margins start getting squeezed, but the good news, inflation is moderating. There's lots of companies whose stocks are down 30% plus already, which are reflecting a lot of this risk. So definitely worth picking away here, especially if you're planning on holding companies only in 12 to 18 months. It's what I'm doing. I'm looking to sell my house even earlier instead of waiting to move in January and then selling my house. I want to put some of this money to work right away. And there's areas that make a lot of sense. Companies that sell inventory and retailers. There's several companies that do that. That's great. That's an area that makes a lot of sense. If you're looking at home improvement, forget about refinancing your home, but how about home equities? More money in homes than has ever been in history. It keeps going higher and higher and higher. People are going to look to tap that equity. And what are they going to do? Probably fix up their homes. So the Home Depots I wouldn't throw or the lows in the same category as Walmart and Target. It's different. I mean, not everything is bad at Target and Walmart. Not everything. Food, energy, discretionary items, healthcare and beauty and furniture. Some of these things are really, really getting nailed. When you look at the home improvement market, that's going to be on fire. People are going to the amount of equity in people's homes, especially, what were they up? 20%, 25% from last year is incredible. It's incredible how much prices have gone up. And yes, they're starting to moderate a little bit, but with low inventory, they're going to stay at these levels, especially if you live in certain areas of Florida and Texas, which see a massive demand, massive demand, even Nevada. That's an area too. So there's pockets you can look at to put money to work.